Hello everyone, welcome to a short lesson video on the topic Standard Costing for Cambridge A-Level Accounting. In this video, we will understand the different sales variances and solve a worked example on the same. And yes, we will also learn a quick hack to easily remember formulas. But before we proceed, please note abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. Two things can happen to cause a sales variance. Either the company sold more or less than the budget, and this is the sales volume variance, or the company sold goods at a different price than budgeted, and this is the sales price variance. The total sales variance is the difference between the actual sales and the budgeted sales. Its formula is total sales variance is equal to actual sales minus budgeted sales, which can be written as actual quantity of sales multiplied by the actual price minus the standard quantity of sales multiplied by the standard price. Next, the sales volume variance identifies the difference between the total sales in the original budget and the total sales in the flexible budget. Formula wise, this can be written as sales volume variance is equal to total sales in the original budget minus total sales in the flexible budget, or standard quantity of sales multiplied by the standard price minus the actual quantity of sales multiplied by the standard price. Simplifying this further, we can take the standard price out of the brackets and write SQ minus AQ, the whole multiplied by the standard price. In the exam, if you are asked to calculate the sales volume variance as a measure of change in profit, there's no need to panic because the formula remains the same. Only instead of standard price, we'll be using standard profit. So a simplified version of the formula will look like this: SQ minus AQ, the whole thing multiplied by standard profit. If the sales volume variance is favorable, it could be because the selling price has been reduced to increase the volume of sales, or the promotion strategy employed by the company has been effective, or seasonal sales have increased volume, perhaps due to a festival or a change in weather, or maybe local competition from other firms has decreased. On the other hand, if sales volume variance is adverse, the possible causes could be a rise in the selling price, an ineffective marketing strategy, lower quality of goods than expected by the customers, or an increase in local competition leading to a lower market share. Let's look at the sales price variance now. The sales price variance identifies the difference between the flexible budget sales and the actual sales. The formula for sales price variance is sales price variance is equal to flexible budget sales minus the actual sales. This can be written as actual quantity sold multiplied by the standard price minus the actual quantity sold multiplied by the actual price. Simplifying this further, we take actual quantity outside the brackets and then we get SP minus AP, the whole multiplied by AQ. Possible causes for a favorable sales price variance are increase in price to compensate for increased costs, increase in price after initially pricing the goods at marginal cost to penetrate the market, fewer discounts allowed to favored customers, etc. And an adverse sales price variance could be the result of a reduction in prices to encourage bulk sales, or increase in local competition which has necessitated price reduction, or price concessions given to some favored customers, etc. Okay, as promised, here is an easy way to memorize sales variance formulas. First write standard quantity multiplied by the standard price. Then change the first term and write actual quantity multiplied by the standard price. Lastly, change the second term and write actual quantity multiplied by the actual price. The difference between the first two lines of this grid is the sales volume variance. The difference between the last two lines of this grid is the sales price variance. Once you have found out the sales volume variance and the sales price variance, the total sales variance is the addition of these two. Let's solve an example to better understand these concepts. The budgeted sales of Pedro were 11,000 units at $6.2 per unit. The actual sales of Pedro were 10,800 units at $6.4 per unit. In part A, we are required to calculate the sales volume variance. So let's get started. So we'll write the formula for sales volume variance first. This is part A. Sales volume variance is equal to standard quantity minus actual quantity, the whole thing multiplied by the standard price. Standard quantity is 11,000 units and actual quantity is 10,800 units. So we'll write 11,000 minus 10,800 multiplied by the standard price, which is $6.2 per unit. So we'll write 6.2 here. Solving this further, we get 1240. Now we have to see whether this variance is favorable or adverse. The management had estimated that it would be able to sell 11,000 units. However, it was able to sell only 10,800 units. This is not a good thing for the company, and therefore this $1,240 of variance is an adverse variance, which will be denoted by the letter A in brackets. In part B, we have to find the sales price variance. So let's do that. So this is part B. Sales price variance is equal to standard price minus actual price multiplied by the actual quantity. We know that the standard price is $6.2 per unit. The actual price is $6.4 per unit, and the actual quantity sold is 10,800 units. So 6.2 minus 6.4, the whole multiplied by 10,800 units. We get 2,160 on solving this. Is this variance favorable or adverse? Now the company had expected that the selling price would be $6.2 per unit, but the actual price was higher. It was $6.4 per unit, which is a good thing for the company, and therefore this $2,160 is a favorable variance, which will be denoted by the letter F in brackets. In part C, we have been asked to calculate the total sales variance. The formula for total sales variance is AQ multiplied by AP minus SQ multiplied by SP. Actual quantity is 10,800 units and actual price is $6.4 per unit. So we'll write 10,800 into 6.4 minus the standard quantity into standard price. Standard quantity is 11,000 units and standard price is $6.2 per unit. So this becomes 11,000 multiplied by 6.2. On solving this further, we get 69,120 minus 68,200, which is $920. Now, is this a favorable variance or an adverse variance? Actual sales were $69,120 and the budgeted sales were $68,200. So the actual sales were greater than the budgeted sales, and this is a good thing for the company, and therefore $920 is a favorable variance, which will be denoted by the letter F in brackets. With this, we have solved the entire sum. So that was a short lesson video on the topic sales variances. In the next video, we will solve a past paper question on all the variances that we have learned so far.